Yesterday, both the euro and the British pound gained value against the US dollar, hitting new one-month highs. At the same time, there is no clear driving force behind the rally in risky assets. Obviously, the European Central Bank and the Bank of England intend to keep raising interest rates as consumer prices remain elevated. The stance of both regulators is rather hawkish. Thus, market participants are pricing in further interest rate hikes, which leads to an increase in the volume of long positions on risky assets, including the euro and the British pound. As for the United States, the situation is different. There are more dovish noises from Fed policymakers. Yesterday, Federal Reserve Bank of Cleveland President Loretta Mester said the regulator should move its benchmark rate above 5% this year and hold it at restrictive levels for some time to quell inflation. This means that the Fed is likely to take a slightly softer approach to monetary policy to manage risks coming from banking sector troubles. Against this background, the US dollar slid as expected. Today's macroeconomic calendar is full of reports on services sector activity from euro area member states. The indicators remain above the 50 mark, which adds to inflationary pressures. The UK is set to release similar data. Its services PMI is also in positive territory, which signals growth in activity. In the second half of the day, traders should pay attention to the ADP National Employment Report. US private payrolls are forecast to have increased by 200,000 jobs in March. This downbeat data may put additional downward pressure on the greenback. Traders may also take notice of the US Services and Composite Purchasing Managers Indices. These figures may somewhat support the dollar. And now let's move on to technical analysis. According to the 1-hour trading chart, the euro-dollar pair has risen above the March high to the area of 1.0975. Today, the best way to make a profit is to go long after the price slides to 1.0927. Thus, the euro has a chance of jumping to 1.0975. If the price consolidates above this level and tests it from the top down, the European currency is expected to advance to 1.1002 and 1.1031. At the level of 1.1031, I recommend going short on a rebound to catch an intraday correction of 25-30 pips. Short positions at 1.0975 and 1.1002 can be considered only amid a false breakout. In this case, bears may drag the price down to 1.0927. In the event of subdued activity from bulls, the euro is likely to plunge to 1.0881. At this mark, it would be a wise decision to go long, counting on an intraday correction of 25-30 pips. Speaking of the British pound, the situation is similar. Yesterday, the pound sterling rallied by 120 pips to settle at 1.2519. Now, long positions will be relevant at around 1.2455. A false breakout at this level will create a buy signal. In this case, the British currency will probably rise above 1.2519. If data on services sector activity in the UK turns out to be upbeat, the pound-dollar pair will most likely extend gains, heading for 1.2551 and 1.2592. At the level of 1.2592, traders are recommended to go short on a rebound to catch an intraday correction of 30-35 pips. Long positions at 1.2551 and 1.2519 can be opened only amid a false breakout. Thus, the pound sterling is expected to slide to 1.2455. If the price fails to recover from this mark by late trade but fixes below it, the British pound will dip to 1.2396, trimming yesterday's gains. At this mark, it will be possible to go long on a rebound, counting on an intraday correction of 30-35 pips. Best of luck.